Welcome back, everyone, to the fourth edition of our quarterly on-credit video. Thanks for joining us. In this edition, we will briefly talk about a few items. First, the impact of inflation on treasury yields. Second, corporate earnings. And third, the takeaways from a recent event, EM conference here in Miami. I'm Alejandro Esteves-Breton, the Chief Fixed Income Strategist.
Hi, I'm Marcelo Menuso, the Chief Credit Strategist.
Hi, I'm Rafael Gaion, Credit Strategist, and we represent Itaú Private Bank.
So we'll start with two high-level views. First, U.S. Treasury yields have moved higher due to investor concern about persistently high inflation, which is likely to delay Fed rate cuts. Second, recent surveys among firms and consumers show marginal improvement around inflation, with some evidence that firms have less pricing power, especially among retailers. Now to the second view about earnings. First, overall blue chip companies continue to perform very well, especially compared to expectations, with both the percentage and the magnitude of earnings surprises exceeding the 10-year average. The first quarter earnings are set to grow possibly around 6%. That's the highest since second quarter of 2022, with 78% of the companies reporting positive earnings per shares surprises and 61 surprising with revenues. Earnings guidance showed a marginal improvement, with 10 less companies issuing negative guidance and 10 more issuing positive guidance. An improvement in earnings guidance may be confirming a clear upswing in global manufacturing cycle. Marcelo, you and Rafael attended a conference recently in Miami. Can you tell us a little bit what the takeaways were?
That's right, Alejandro. Rafael and I attended a large EM conference here in Miami last week, actually. Whenever possible, we take these opportunities to meet with bond issuers to get an update on their financials and to learn about their business outlook. We met with 20 companies in 10 different sectors. I can say that most of our meetings went well. Companies we met with are generally in good shape. The revenue outlook varies. Some companies they have a better revenue prospect than others. But cost improvement was a common topic across different companies and different sectors. It's not to say that there are no cost challenges, quite the opposite. But it's fair to say that inflationary pressures do not seem to be as intense as in previous years. Balance sheets are also in good shape for most bond issuers we met with. Companies did a very good job in terms of extending debt maturities and in terms of lowering their interest costs when global interest rates were much lower a couple of years ago. Finally, another great insight we get at this conference is investor sentiment, what other people are thinking. We get the opportunity to speak with other bond investors from several different countries. And I have to say, investor sentiment was constructive this year. While investors are mindful of tight spreads, it is also hard to see clear negative catalysts, given that the economy is in decent shape and default expectations are down from previous years in emerging markets. So, as a result, most EM bond investors, they share the view that if we don't have an unexpected market shock, the EM fixed income backdrop bodes very well for a solid performance in the coming months.
Rafael, you also met many companies at the event. What do you see as particular opportunities, especially in the face of treasury yields moving higher so far this year?
As Marcelo said, the revenue outlook varies depending on the company. But overall, management was more optimistic than last year. In special, companies in the basic materials sector have been more positive on the outlook for commodity price. To be fair, they don't expect significant increases in the price of commodities, but they believe that the current level should be maintained. This would already help cash flow generation, and given the current yields and better outlook, we have an overweight allocation to the basic materials sector in both developed and emerging markets debt. We are also overweight in financials for both, again, developed and emerging markets. The banks that we cover are large and systemic. Earnings are solid, but the sector still offers a premium to peers. Last, even though guidance has also improved in our meetings with consumer, non-cyclical, emerging market companies, we maintain our underweight on the sector, waiting for better profitability in the companies that we follow.
Thanks very much, Rafael and Marcelo, for the color. Thanks everyone for joining us today. And if you have any questions, please feel free to reach to your investor or your banker. And we'll hopefully see you next quarter for a new edition of the On Credit.